Welcome back. I now have with me the brains trust of Citi's economic research. David Lubin heads the study of emerging market economies, and Johanna Chua heads the study of Asian economies. Johanna, David, thank you very much for joining me. David, first to you. Now, just in the last few days, this very strong US jobs number seems to give the impression that global growth will not be all that bad after all. The IMF also has said that global economy will not be as dreary as they thought it is, not that 2.7%, maybe a little better. Do you think that global growth will be better than you thought, and will emerging market economies benefit?
Let me pick up on the point that you made at the first point, the jobs data that we saw late last week. As far as emerging economies are concerned, there's a bit of a paradox when the United States economy is doing well, because as the data showed, the labor market is very tight in the United States, the demand for labor is very strong. That means that US monetary policy is more likely to tighten. And we expect the Fed funds rate to reach something close to 5.5% by the middle of the year. That's much higher than those priced in the market. And the risk is that if interest rates in the United States rise further than the market is expecting, that might deliver a negative shock to risk appetite towards emerging economies. And so, on the one hand, of course, it's good news for the United States economy to be doing well. But on the other hand, the kind of paradoxical result is that that may contain bad news for emerging markets, because it destabilizes risk appetite if the United States if the US Fed has to tighten monetary policy further. The other consequence of further monetary policy tightening is that it increases the risk that the United States will fall into recession in the second half of the year. It's possible to talk about a policy-induced recession. In other words, the recession that might be necessary for US demand growth to weaken sufficiently to allow inflation to fall back to the 2% inflation target.
Well, Johanna, I have to persist with this, with one more question before I come to the other big economy, China. But David, if that's the reading, are you expecting that the US Fed will hike more than what the market is expecting? The market was expecting maybe one more hike and then a cut by the end of the year. Do you think it's not going to be one more, but maybe two more hikes?
That's right. I mean, the market's pricing of the terminal rate, the end point of the Fed hiking cycle is around 4.9%. And we would think it's closer to 5.5%. And we also think, unlike the market, that the prospect of rate cuts in 2023 is very low indeed. It's much more likely that the first rate cut will take place in early next year rather than in late 2023 as priced in the market. So our analysis of the US labor market makes us think that the US labor market is tight enough to require further action by the Fed.
Okay. That will mean follow-through questions on Asian currencies and Asian credit, but
Sure.
I'll come to you in a minute. Johanna, the big theme over the last few weeks or even months is this China no-COVID policy ebbing and China opening up. Do you see fairly strong growth of China in the current year? And what does that mean? Who can be the satellite economies or the sister economies that may benefit?
No, absolutely. We just recently upgraded our GDP growth forecast in China from 5.3 to 5.7%. And a big part of that is also obviously the zero COVID. I mean, three things have happened. Obviously, they've reopened much earlier than expected. They reopened almost everything simultaneously, whether it's domestic or cross-border. And the other thing that was actually surprising is earlier there was a bit of concern, maybe the COVID would have multiple waves and we may have another surge during Chinese New Year and that could kind of suppress activity. But it turned out, actually, the COVID peaked much earlier than expected, and it's been actually coming down. I think the fear of another upsurge has kind of dissipated. And so, therefore, we're seeing a faster resumption of activity. And you saw that during the Lunar New Year holidays, when you talk about visitor spending and travel, it seems like Chinese consumption has been back. Now, when you think about what this means, the impact on China, what it means for the rest of the region, as I said, we upgraded our GDP growth in China, but we have to look at the composition of growth. What is driving the growth? And we still think the biggest driver is really going to be household consumption. Again, the normalization a bit of consumption activity. And even within consumption, it's really the most suppressed activity, like services, that is going to bounce back a lot more. I think, of course, there'll be some spillover on goods, but the delta change proportional impact is not going to be as big because goods demand was not as suppressed during the kind of COVID wave. And so therefore, it's going to be very disproportionate. Now, having said that, obviously, when we think about international spillovers, we have to assess, well, what does that mean? Consumption, especially services, we tend to think tends to be non-tradable.
Yes.
However, I think one of the positive surprises we saw in the last couple of months is, well, they reopened the border much quicker as well than expected. So there will be some spillover of important services demand via kind of channel through the cross-border travel. And there'll be a few winners here and there. As you know, in Asia, it's going to be places, the obvious places, Hong Kong, Macau, we're going to see it in Thailand, maybe Singapore, Malaysia, Vietnam. Unfortunately for India, tourism is really not that important. Now, the key thing we need to watch is on the investment part, because obviously investment, the same way in which we had an investment-led boom after the global financial crisis, tends to have a lot more global trade spillovers and tends to be a lot more commodity intensive. Now, the good thing, in good and bad, is on the one hand, investment growth, we're not expecting a big surge, but the positive side of that is that at least that means that China rebound is not going to be as reflationary on commodity prices, which again, in a world where people are still somewhat worried about inflation, that structure of rebound in China has narrow growth distributional impact in a few economies, but doesn't have as broad-based inflationary impact, so at least that can hopefully propagate a bit of a Goldilocks scenario for global risk.
Well, you answered my second question, because I was going to ask you if, the strong Chinese growth will mean expensive commodities, since we are also battling inflation, albeit not so big. Okay, now to come back to the impact of this higher than expected or more than expected Fed hikes. We've already seen the dollar bottom out, around 100 and now come to 103, 103 and a half. The DXY. Do you see dollar strengthening a goodish bit and therefore weakening in, more weakness in EM currencies?
Well, that's very good question. It's exactly the risk. What we saw last year was a situation where the dollar was appreciating sharply against the background where US monetary policy was tightening. And so now the situation is that if we're right in thinking that the Fed has to hike more than the market expects, the risk is that the dollar might strengthen in accordance with that further tightening of US monetary policy. And you're right to suggest that that, in turn, might destabilize emerging market currencies. Yes. I think that's a genuine risk in the first half of the year. In the second half of the year, as the US recession becomes more evident, it's much more likely that the dollar continues to weaken again. Okay. And so, in a way, it's a kind of year of two halves. The risk is that the dollar continues to appreciate in the short run, as it did after the payrolls data on Friday. But once the recession is entrenched and US interest rate or US yields, bond yields, continue to decline, that should cause the dollar to weaken further, and that helps to support emerging market currencies. Just want to mention one point about China, following from what Johanna was saying. One of the consequences of the border reopening in China is going to be a very serious deterioration in the balance of payments. Not a chaotic deterioration.
In China's balance?
In China's balance of payments, partly because the outflow of tourism, which in 2019 cost China $220 billion of outflows, but also because in the past we've seen a close relationship between the outflow of people from China and the outflow of capital from China. And so while the foreign exchange market's response to the China reopening was to buy the renminbi, and so the renminbi has strengthened, the effects of this deterioration in China's balance of payments in the second half of the year might be to create more volatility in the renminbi, and that could have some effects on Asian currencies.
So it's possible it will go back above 7.
It's possible.
Johanna, you touched upon the fact that India could be seen as an alternative destination for investments because of this China +1 policy. Do you actually see it? From your perch, you can see where the FDI investments are flowing. Is India 2, 3, 4? I know we are not the first in terms of alternative destinations. Do you see a goodish amount of money coming?
Of course, it's very hard to disentangle how much of investment in India was going to happen anyway, regardless of what happened in China. So it's very hard to really pinpoint. So what we do, we tend to look at the trend of manufacturing investment approvals, for example, as maybe an indicator that maybe something is up. And that certainly, in Asia, We've seen initially in the US-China trade war that manufacturing investment approval picked up a lot in Vietnam and Taiwan. So that was the first wave. Some of it Taiwan because there was a returning of the IP-sensitive sector. But lately, what we've seen in the last couple of years is that we've seen Malaysia pick up and India pick up quite a bit. So clearly there's been a kind of, there seems to be a sign that something, there's traction growing there. The other thing we look at is we look at this news flow, factory relocation news flow. So there's a database that tracks reports. And what we see is there you do see a palpable sign of kind of a pickup. I mean, we see these stories in Apple, but definitely on media reporting of factory relocation, India definitely seems to gain a lot of traction. The other thing we look at is, we just kind of look across Asia. I mean, who are the obvious alternatives for China? And so we look at, whose industrial structure is quite similar to China. And in a lot of our analysis we've done, we've done some piece globally, but in Asia, the two economies that are most similar to China is actually India and Vietnam. But, Vietnam is a very, very small market. So when you need to scale up, and a lot of money already went to Vietnam earlier, it seems like India is having a moment.
Okay. Yeah, and we have to grab it. Well, I want last two statements about India from the two of you. First to you, David, how do you assess? Maybe this year there will be some global headwinds, but is there a strong structural story? We like to think there is, but please be candid. Do you see a good medium-term story?
Everything is relative, and in relative terms, yes. India is unusual among developing countries for having a growth-focused, infrastructure, investment-focused government. And also policymakers that are kind of paying attention to the control of India's balance sheets and the control of India's balance of payments.
Yes.
So all in all, in a relative context, the quality of Indian policy making is really quite strong.
So there is a good story, good opportunity, but much will depend on what actions we take as a nation and as a government. Thank you very much, David and Johanna, for joining us with the Citi View.